Thanks, Dominic. Very insightful, and like you mentioned, you were able to take us through the overall model in terms of how you thought about customer, how you structure your offering, and how do you draw the acquisition to be able to get to the top right quadrant. Let me start a question with Dominic, and we get into Shashank. So Dominic, one of the key dimensions you talked about is two areas. One is private equity firms come in and buy a digital engineering company and then try to transform. And second is you mentioned about these two sets of companies, which are the European company. There are several of them which were like how Altran was 7 years ago, and they have to drive transformation. And they have to drive transformation inorganically. And then they have all of these industrial companies. It could be ABB, it could be Honeywell, it could be a lot of other companies, or the large IT services company, what Accenture did, MLOT, right? They would have to buy. So if you are a engineering services firm, the founder-led, the company had been around the last 15 years, how to evaluate these two options? Is there one option versus better, or how do they think about this?
So, in fact, that's of course a complex question, but if you have a clear path to develop your company with a deliberate strategy and that you know what you have to do and so on, then finding a financial partner, and Shashank is a master of that because I think he has 2 or 3 turns of PE. I did work with one PE who helped me a lot. It was a Pax partner and so on. Then a PE is a great partner, depending the PE, but it's a great partner because it's access to capital, it is discipline, and it is stability when few things go wrong, which happened to me, by the way. I had to go fix on my way a few issues. But I was also intensively acquiring and so on. So it helped me do the build-up myself because that's the purpose of the private equity. A strategic would, it's something else. It's more an outcome because would consider the value or the chromosome or the addition that you bring to their company. Right, so it's not the same, I would say, tempo or phase of thinking, and both have a real advantage. I would tend to say that with the industry being on steroid in terms of multiple, and this is going to stay for because there is a scarcity of good asset. In fact, I mean, having a financial partner like a PE is a great thing because you maximize, and the master of that is Shashank, because the multiple that he got for GlobalLogic is beyond imagination. It's 37 times EBITDA. Now, why do the large strategic do that? Is because what I call the big balance sheet, industrial or IT services, back to your question, and I'm done, is because simply put, they want to stay relevant in the digital era. And Shashank cannot mention that, but Hitachi cannot make their technology relevant without being really fully in the digital software engineering and design. So they need people like GlobalLogic to make their technology relevant. I can illustrate that with real example. And Capgemini, like Accenture, like Atos, like all the big guys, have understood that their industry expertise and engineering skills are way too short to be able to digitalize or help clients digitalize their operation that they understand shit or little. So they have strong motive to get there, but you need to choose. And back to you, Pari, whether or not you want to develop your company with a financial partner like UPE for a few years, or if you want to go directly help a big balance sheet to get relevant in the digital era.
But thanks, Dominic. And Shashank, just diving on the same question. And you have worked, like Dominic mentioned, you have worked with several private equity firms. So what is the journey like? So when you chose the first one, what's the next one? Are there a certain set of value you were expecting in the first one, and then if the change happened as the company went through multiple inflection points? It'd be great if you can take us through the PE part of the journey.
Yeah, so I think, Pari, the interesting piece is, first of all, I will say that if you're a really good CEO, you don't prepare for sale. You prepare to build a good to great company. That is important. You make the people come to you to buy your company. The moment you are trying to do a process or auction, in that case, and I'm sure there's the same experience Dominic has, then you're already searching to the bottom. Okay, I think that is first important part. I think what I gathered in the entire journey is at the stage of the company where your company is, your investors do change, and they should change. So when GlobalLogic was, let's say around, so I joined the company, it was around $30-40 million company in 2008, and we started moving from there to around 230 million, 240 million by 2013. We realized that, and we are fantastic investors. We are VCs, which is like Sequoia and Enia and Draper and Goldman. These are great VCs. But we realized that VC has a different mindset. VC's mindset is they're quite much in detail. They're actually more technology, what you do where. Their ambitions are not as much as you see about Google and all, but the ambitions are not as that large, right? And they also lack certain amount of discipline in terms of the company's operating. They're not hands-on operators in a particular company. They're disciplined in their own business, but hands-on operators. They're more actually in the bigger picture, guys. So we realized by 2013 that if you want to go to the next path, you only two paths, either to take it public, and I realized from my prior experience, which, Pari, you know that services companies should not go public which are too that small. They should at least go public when they're billion plus because of a variety of capital market reasons. So we realized that we need to go to a partner which has the acquired capital, which has required discipline, which can build a credibility and build the relationships. And that is the area where a bunch of options, and we selected Apex. Apex is 3/4 of the partners are McKinsey guys, so they're growth oriented. And it's very important in private equity, you select growth oriented, not squeeze oriented. But I think that ran from 2013-14 to around 2017. Then we realized, I think because all these P's also have their fund duration. So you might have 10 years long or 15-year cycle. They're only 3 to 5 year cycle. Then we realized that we're still not at billion. So we need to go to the next partner. And we don't never want to sell the company. We have not actually ready to take it public. And that is the time we realized, and we actually, I personally got educated saying that let's go to the root of the money. Let's chase the money. Where the money comes from. These are all sovereign funds. Whether it's Norwegian, whether GIC or Temasek, or whether it is Canadian pension funds, all these guys, rather 14 or 15 of those, they are the one actually fund P's. And through APAC's conferences, LPAC conferences, I got educated about it thanks to APAC's. And that's where actually, if you take Partners Group, which was funded funds that time, and now is nice large P, $100 billion plus, and CPPIB came in. So I think in your journey, as your clientele changes, as you start aiming high, you also should aiming high in terms of the investor which you are going to have. Now, having said that, you need to ambition towards that. That's the reason initially I said, you need to prepare the company to be highly successful, not to figure out what it fails. And when you do that, you also try to bring your employees, your clients, and your investor, all of them of the high pedigree.
Thanks, Shashank. So I think we're aiming high and then going through the value in terms of what value individual private equity can provide at different stages of the company, and you're able to bring them in at different stages. And the great insight is, you should be looking at building a great company, not to selling the company. And automatically, you will have people both in the strategic and private equity wanting to buy the company because you're adding.
And Pari, I will say this. I think my friend Dominic will agree with me. Neither of us actually trying to sell the company. They come to you, and that's actually that's the genie out of this, right? I think when they come to you, I think that is the time your company is valued. Would have been successful either public market or the private market. And if that is the case, the best assets always has actually demand in the market, and there is a scarcity of those, as Dominic rightly pointed out.
Great. And Dominic, adding on to what Shashank mentioned, you had done a number of acquisitions as you build the industrial global shore as well as the overall digital engineering capability. And how did you choose these companies to buy, right? There are several companies you bought before the Addison acquisition, and then you did Addison acquisition. And some of these are much smaller companies. And like Shashank mentioned, were you looking for companies which are not looking to sell and then went, and how did you identify whether servicing a customer or what are the key triggers in identifying those companies? It'll be great for the CEOs to know.
Yeah. So it's a great question. What I shared with you in my deck and the first question was in short, and I'm answering the question immediately. In fact, the clients are big guys, big companies who are doing things in a deliberate way. They are opinionated. They know what they're trying to do is challenging. And the same on the large company like GlobalLogic or Altran. We had a deliberate strategy, and we said we're going to go do that and so on. As a consequence, Pari, my acquisitions were only linked to my strategy. And I never got distracted by trying to make more profit or things like that, or get bigger and so on. What do I say? It means that in the high value space, digital space, we went to very small asset because we were nowhere in software engineering while GlobalLogic was already big. And we acquired, for instance, a company in Ukraine called Loika because we said, okay, we need to start, and the best software engineers are there and so on. but we acquired small data analytics companies. So it was always in that segment for a specific expertise. And by the way, not only expertise, but underneath that, the model. I will come back to that later on if we have time, but we always searching for people who not only are passionate with that domain or expertise, but have a model so they would deliver in an effective way. That's one. And two, of course, we started building nearshore and offshore capabilities to be able to leverage the great talent that we have in India or in Ukraine or in Morocco and so on. So that was the second angle for my acquisition. And I'm not regretting 1 minute because some of them were expensive, some of them were challenging, but I'm not regretting 1 minute to have followed this discipline track.
And thanks, Dominic. And if you want to start talking about the value creation levers, and one of the value creation lever, Shashank, that we have looked at GlobalLogic from several private equities, right? Different parts of your journey. We have done the due diligence for different companies. And one of the things which comes out every time we do a due diligence, like your customer segment continues to stay with you. And even it's almost like Google. Like Google is very easy to change. So in services, that's what you say. Okay, it's easy to change from one provider to another provider, but GlobalLogic customers tend to stick with you. And we saw that even during the COVID times. And one interesting insight you had in yours, almost like a SaaS company, 114% of growth from your existing business, even if you stop selling. What is that in the culture of the company which allows you to keep this customer? And we've seen several companies. We just did 2 due diligence for companies. And then you see this churn of customers all the time. Their sales are selling and to get new wins, and they're losing some of the big customers. But in your scenario, you kept on growing existing customer, keeping existing customer, adding on new customers on top of it. So what is that in the culture of the company which allows you to do that?
Yeah, so I'll answer both your questions. I think partly some of us actually, like Dominic and me, cut our teeth in the companies like IBM, which customer was paramount. I think relationships are everything. My personal belief is you invest in relationships. And this is what actually I tell my sales guys when a new sales guy joins or new account manager or delivery manager joins. This is what we actually preach inside the company. You don't actually have relationship on transactions. Transactions come and go. You might sign a deal, you may not sign a deal, you might lose a contract, win a contract. Sometimes the clients move from one company to other company and suddenly you lose touch with them. At the end of the day, you are actually investing in the relationships. And those are 1:1. These are people relationships. That is number one. Number two is if you start actually helping the clients to increase their business, to start working their top line, they will always be with you. If they are trying to save only their cost, in that case, actually, you'll be parted towards further down to the procurement organization. And procurement has only one view in terms of how I'm going to get the least common denominator, least common pricing, right? And that particular thing doesn't have any loyalty, doesn't have any relationship. So I think everything what we did, and partly this actually helped us because we don't work in IT services and BPO side. If you work in that segment, I think probably I would not have that kind of luxury to what I'm saying today. But when you work in digital engineering services, product engineering services, those are the areas I think it does matter. It lends you the way to actually meet the CXO level executives, the CEOs of the companies. But you actually advise many of the CEOs. Why they sit with you? Because you offer, why actually oftentimes Dominic and I sat with you, rather on the weekends we are the calls because you get a value. When you get that value to make your business better, that relationships are always lifelong. And again, I said that is a relationship. Those are not our transactions. Many people who join our company who believe in transactions, those people actually don't last long because company is based on that. That is a company's fabric. That is number one. You asked the other question about the valuation side. I think there are 3 things I learned. I didn't come from services side. I come from product side. In HP and IBM, I'm always a product. Actually, services I landed by an accident. But the thing is, what I learned is, number one is you need to break the linear equation between employees and revenue. This is the biggest curve for service industry. So if you start getting your gross margin towards 40, 42, 45%, you start getting the valuation of the lower side of the SaaS companies, which are HCM sector. Just check it out, Workdays and all. Their valuations are actually, their gross margins are 45, 48, 49%. You naturally start expanding that, number one. Number two, there's a rule of 40 formula in the service industry. That means your revenue growth percentage and your EBITDA percentage, if you add percentage, it should be 40 or plus. So if you're growing at 20% revenue growth, then 20% should be EBITDA. If you have 40% revenue growth, fine, actually, you can cut it, you can lose some money. That's perfectly okay. And that actually shows that your company is healthy, right? So that is the second part. And the third part of the equation is How much of the revenue, this is again going back to SaaS, how much of the revenue is a repeat business? So you just shut down your sales. Can you still actually have the staying power? And we count that in net dollar retention rate. That means it's say that, and because any given year in the service industry is very difficult to get net new business from the net new client more than probably somewhere between 5 to 7%. No company can do better than that, right? If that is the case, unless until you do platform-based sale. And if you do that, that means you need to have to get around 20-22% growth. You need to have the coverage on the next year from your current clients at least 14% more. When you start talking about those parameters, you start feeling actually, you start looking more like or lower side of the SaaS companies or the product companies, because their parameters are similar, financial parameters, not the way they operate. I think that's where actually your valuation comes in.
Got it. Very interesting. So you almost changed how investors look at a digital engineering company from looking at an IT service and say, hey, that's not the measure. Our business almost looks like a SaaS company. And that way you have to start looking at it.
And Pari, the reason is a financial investor. I think you know that. I think GlobalLogic gone through the entire round, rather you're involved in that entire round with the public markets. I think when the financial investor looks at it, I'm talking financial investor, not your clients, not your employees, or not strategy, financial investor. They try to compare businesses side by side in terms of return on their capital, return on actually the investment. When they look at that financially, for them, it doesn't matter what Workday does or what somebody else does and what you do. How is your company? How am I actually going to have my investment to do better? And when you look at that, then you figure out, can we do it? And the answer to that question is yes, you can do it. To the extent, and I might be actually making some explosive statement, the Palantir company is more services company. Why their valuation is high? Because of platform base, and you can see their gross margins. So I think you need to go back to the basics to actually identify, and you can do that in the service industry.
Almost going back to first principles in terms of how does a financial investor value the company and drive that. Dominic, so adding on to what Shashank mentioned, if you're a CEO of a company where you're starting to get requests from different buyers, right? How do you get prepared for the process? Do you work with an advisor? Do you work? How do you drive that? Take us through a process of the great experience you would have had in buying a company.
Yeah, in fact, echoing what Shashank said. We should never try to sell a company. That's the best way of not getting the value. So the first step, I believe, is to have a clear view articulated of a strategy and opinionated and a roadmap of execution, so that then when you are contacted, you can try to sell the future, if I may say so, without being cynical, but with real roadmap and so on and so forth. Advisor, of course, help you a lot. Because they are super strong, especially the bankers, to put that in equation. And I whether it was when I was acquiring, like I recently, it was a 2 billion acquisition, so it was quite big, or when we got acquired by Capgemini, you do need them. Even with super staff, you do need those people. They are master at doing financial modeling and modeling of the asset. But at the core, and I'm sure Shashank will echo that, the real difference will come from the CEO and the team, the executive team that's going to put the strategy and the value into this model. Otherwise, it's just blah, blah, and big models. So it's a complement. You need advisor, but before that, you need to have your strategy and be able to inject it in the model. And then I would say the name of the game is to try to explain whoever is the buyer, I'm on my way to deliver significant value, and you need to pay the future. I'm almost sure Shashank asked Itaki to pay the future, but it's not a bad deal because they understood that he would go there anyway. So better do the acquisition now and get this value later on. So that's the high-level summary answer.
Just to add on question before, we have started to add all the CEOs into that so they can start asking questions. I'll moderate with that. One other question is, always there is a concern on founders' mind. Have we left money on the table? So that's always, should I sell sold? What is the right price? What is the right time, right? Is there a way to even time the market? What do you think, Dominic? What should the founder think about it?
No, again, distinguish two things. Having a financial partner like PE from answering to the request of a big strategic, someone who want to buy you. A PE would help you to develop and maximize the value. So your question applies to, I get contacted by a strategic, and here it's a very difficult question because we finally agree. I was chairman of the board at Altran that we would sell for whatever 14 euro a share, but we were also regretting it was that, and we spent nights and nights and nights discussing with the board and so on. But at the end of the day, you need a philosophy. When you say yes, because it was good not only for the money, it was good for the stakeholders, for my shareholders, but for my employees, for the industry. It was a great deal. So we said yes, we go, and then you need to stop regretting, because you can always think that you are going to optimize.
God, and one of the things we have seen is the founder's identity. I'm a founder entrepreneur. A lot of identity is linked in the company. So on some level, when somebody is buying an organization, hey, how much are you going to take care of? Like your children, right? How much are you take care of the children? So is there a way when you say, hey, I'm going to keep this organization in some level, protect the culture and identity of the organization? How much is important to founders that versus pure, financial returns from both Shashank and Dominic? You can take it based on your experience buying companies, smaller companies, less than $100 million companies.
I'm going to let Shashank develop longer, but it's a good question, Pari. And Shashank said we should not try to sell a company. It's an outcome. It's a result. The goal for us and for all of us is to go develop great business and be proud and so on. Here it is the same. I belong to a category of CEO who get pride because what I left behind me is still working really well and the people are enthused. So for me, it's absolutely critical when I sell my company. But I was trying to check the same when I was acquiring, that the CEO or the founders would try to honor that. And by the way, all of those CEOs that I acquired with their company are either with me or friend, because they had this kind of attitude and so on. Shashank, I don't know what you think.
Absolutely. I think, Dominic, I 100% agree with you. I think, Dominic is more successful than me in M&A. I can tell you, I can give his hands down to him, because the reason is over 13 years, we acquired close to 10 companies. My only regret is we should have actually done more and big. And we did not do that because we had to create the culture in the company which will be acceptable to the acquisitions. And lately, actually, we did better. But Dominic always actually was bold. He was relentless in that. There is some more transaction I can say, but that I'll not name on the call. But Dominic actually took it off our mouth, which is amazing, by the way. But I agree with Dominic. I think at the end of the day, you should give the respect to the founders of the company you are acquiring. I think they have a certain culture, but at the end of the day, I think the new company should blend in your culture. And you have to also understand that all these companies which come together, and we did 10 of those acquisitions over close to around 13 years period, they actually also make your company's fabric better. This is a fabric. Your culture is a fabric. You're going to weave different kind of cultures to come together. I cannot say, our first acquisition was actually a company in Nagpur, right? And the second acquisition was a company in Ukraine. And then we went around the world in terms of acquiring the companies. There are companies came from design angle and data angle. Companies came from industry angle, but all of them together. So every time you acquire something, you are going to get something unique. And you blend it to make your culture. And that's what actually, and there's a reason, and the custodian of that is actually custodian of your HR and CEO. These are two custodians to make it happen. But I agree with Dominic. All those CEOs who came in, all the way actually, and for that the company, which Shashi's company, which we acquired even before my tenure, till actually the recent acquisition of ECS, all of them are either in the company or they are continuing to be great friends. And that is very important because they should also have pride in terms of what they did and actually what they contributed ultimately to GlobalLogic. Great.
And I have others, if everyone can, switch on your videos and how, we don't need the holding slide, Hasha. And Howard from Acuon Labs, you had a question. Do you like to unmute and your video and audio and then mention that? Ask the question.
Hi, this is Vishal this side. Can you hear me?
Yeah, go ahead, Vishal.
Okay. So my question is, often you are in a dilemma that whether an organic growth is the right path to progress or going in for acquisitions of companies. How do you really take a call that which path is the right path to take up, and what is the right strategy for growth of an organization?
For your own growth, not you.
Correct.
Okay,
yeah.
got it. Okay. Yeah, go ahead.
Growth, yeah.
So my belief, I think, is you need to actually have acquisition as an integral part of your strategy. What acquisition brings you is the credibility. Is very important. You might decide to go in, and I'll give last example. We decided to go in automotive sector around 6 years back. It would have taken us probably 8 to 9 years to actually, even if you buy the talent, even if you try to actually figure out all artifacts and everything, to create that particular moat, create that particular credibility in the market takes eons to come. Acquisition actually makes you actually that happen. You need to have, even when you make your 3 and 5 year strategies, I think as much as your organic part is there, which is going to accentuate your current strengths, your new strengths also can actually happen much faster by the acquisition. I would say that acquisition should not be the reason why you are doing is for trying to increase your revenue or bottom line. It should be actually addressing a white space which we have. And if you do that, in that case, you get that advantage in time. Dominic?
Yeah, I'm not going to repeat, but that's what I said. I never did acquisition just to be bigger or buy profit or revenue. It doesn't make sense in my view. So the acquisition is, it's like if you think that your DNA and your chromosomes are going to enable you to do something adjacent or more fast, don't do acquisition. If you think that you need a chromosome to do something which is not in your DNA, and given the time to market pressure that we have, then it's much better to deploy capital and go do those acquisitions because time is passing. So it's a blend mix. By the way, the CEO and the management team have a very strong influence to have this appreciation on, do I need a chromosome or do I have the chromosome and I'm going to expand what I'm already doing. But for instance, Shashank was already in the software engineering. That's the way I saw him years and years ago. He was small but brilliant. And I understood that I didn't have that chromosome. My folks were good in embedded software. They understood nothing in real software engineering. So I had to go acquire a company in Ukraine because I would have spent 5 years, while in 1 year I got it done.
Right. Well, thanks, Dominic. Dimitro from Onyx System is a CEO and acting CEO. Dimitro, you want to switch on your camera?
Yes, and for some reason I cannot turn on my camera.
Sure.
I think you need to allow me first.
Okay. Go ahead.
If you can hear me.
Yeah, okay. We can hear you. Go ahead. The question.
I actually was going to ask Shashank what makes you different from other large outsourcing companies when you are talking to your clients, because there are a few large outsourcers and probably you can bid on a project and the budget $1 million, and there are a few in Ukraine. It could be, I don't know, EPAM or others. So when you're talking to your clients, what is your answer? But if you allow me to ask 2 questions, then the second would be regarding, in continue to previous attendee, actually, if I'm a company that would be acquired, what benefit will I get to be acquired? So, if possible.
Yeah, so I'll try to answer the first question. I think the good news is the digital engineering field is so huge and digital disruption is so huge. And I think the COVID has actually accentuated that even bigger, that I always call it as an elephant. So all of us are touching different parts of the elephant, but we don't have the entire elephant together with us. I think the companies which we see, which is similar to us in the market, are like companies like ThoughtWorks, companies like EPAM to a certain extent, companies like Globant, companies like Endavas of the world. I think Altran was one of the companies. There are far and few. If you take actually collective, all the revenue of these companies combined is not even more than around 10 to 11 billion. And Dominic already told you the amount of money which is spent in the R&D alone. So number one is, if you see that most of the time we don't see each other because we are working on different industries. Mm-hmm. I work actually on the industrial side, or work and EPAM is working on the transportation side. We don't actually play across those industries, right? So that is number one. Number two is our formulas are different. I think our go-to market is very different. Our go-to market is we never go to a client with our slide deck. We just go and actually sit with the client, with CEO, C-level executives, and start talking about their problems. If you talk to any CEO, they want to talk about their problems, right? If somebody comes to, like Pari comes to you and say that, hey, Dimitro, tell me actually how the business is better than Pari coming with a slide deck or 50 slides. And when you start talking about it, start connecting the dots, and then start, okay, fine, I think we might be able to help you over here, or somebody will help you over. That's the reason I said we invest in relationship than actually transactions. So if you ask me, if you take the competition, is less concern me. The reason is my biggest competition is client is going to do this in-house or client is going to do with me. That's the biggest competition. I don't think there's ever actually, it's all the CEOs are our friend. Just like Dominique is my friend, so is Ark, and so is everyone actually, which I mentioned earlier, right? My personal submission is, I think there is enough market right now for next close to 10 to 15 years. The amount of digitization has to happen is so huge, and it's just starting. We're in the first adoption curve, right? The enough market that will be enough for us to do. The question is, are we going to create our own niche, own specialization, and we are going to go for that. One other thing actually at GlobalLogic, right from the beginning, we decided we don't want to be a copycat. You don't see my organization to be anywhere near to Infosys or Accenture, the way it looks like, or to EPAMs or anybody of the world, right? You have to figure out your own formula, because if your niche is unique, then your organization is unique, your go-to-market is unique, how you measure. You saw actually how we measure. Most of the companies don't talk about net dollar retention score. We measure that, how that is different. If that is the case, there is enough space in the market today, especially in the data engineering and digital side. I cannot say the same thing about IT services and BPO, because that is a very different market. That's a very mature market. And I think Pari can have a separate panel to talk about it. Your second question about what you get in return. As a CEO, I have two titles. You saw that earlier, President and CEO. President title actually deals with today in terms of giving my quarter and year, and CEO titles look beyond. I always try to think about the institution, not about me personally, but not about my management team, but first about institution. When Hitachi acquired GlobalLogic, what it means to my, yes, investor, but more importantly, my clients and my employees. You can answer that particular question and you actually can live with your own conscience, then that is great. And that's what you look at it. In the journey, as I said in my last slide, as a journey, when we saw that, can we go to $1 billion to $2 billion? Yes, because you're growing at 20-25% organic. Every 3 years, you're doubling the company. 2 to 5, yes. But can you actually get a canvas to paint actually $80 billion company's digitization journey? Answer is no. When we looked at that, when we want to get on the same platform as where Accenture and others play, I think I realized the answer is actually to tie hands with Hitachi. And there comes actually good for everything. For a CEO is, I think me comes later. And Wi-Fi, we call Wi-Fi FM. That is what's in for me comes later, because if you try to solve the problem for the institution, your own answer you get.
By the way, on that, you may know, guys, that so I was listed, unlike Shashank. My company was public, and I was chairman. So when you are listed, you have fiduciary duty, which we cannot breach. It's criminal offense to do that. Where precisely when you're checking the deal, you need to put yourself beside, and you look that if it has value for the stakeholders, and the regulators of listed company are checking that. Stakeholders are the shareholders, obviously, but not only the client, the employee, and the society itself in terms, exactly what Shashank, in terms of moral person. And it means that sometimes you can accept a deal which is a slightly lower for the shareholders, but you have to accept it because it's good on the rest. So it's a tricky balance. And by the way, when you are listed and you have an offering, which happened to me with Capgemini, you spend days and nights with the advisor and the lawyers to go check in a very neutral way, like Shashank said, if it is good for the stakeholders, including the society. For instance, in my case, we could have debated forever if it's 14 euro was enough or not enough and so on. But because it was good for the employee, for the clients, for what we would do in combination and so on, we had to conclude. And it's not rocket science, right? If there is a degree of appreciation, yes, we could not refuse that. It happened that I was in favor of that, but that was a secondary aspect.
Great. Thanks, Dominique. It looks like you are to optimize for the stakeholder. If you optimize for all the stakeholders, including society, employees, and customers, and then whatever is right for you will automatically happen. Right? It's a little.
But you know, if things are well done, so it was the case for Shashank, I guess, because he was PE owned, and it was the case for me because I had a board being listed. Normally, the board or the PEs are aligning the interests of the management and the CEO to that kind of thinking with high level of integrity. If it is not the case, it means that there is an issue in the incentive and so on. And
all that. Got it. And the next question is Vitol from Spriosoft.
Okay, yeah, it's a pleasure to be here. Thank you very much for having me here. And I have a very short technical question. We know that in a service business, small companies have no really big future and they must grow. And actually, that's the driving force for the service companies, that they must grow. And I have a question, Shashank, to you. It's a very short one, because you gave a limit, set the limit for going public for the company, like a 1 billion. Could you maybe share why, actually, and where this level, or why this level is set on 1 billion?
No, I think companies have gone public with all even before that. If you see EPAM got public when they're around 300 million, Globant actually similar size, Endeavor actually lower size, they can go. I was part of the public company before. This was public. And my submission is, I think at a certain scale, at a certain valuation, you get a certain kind of public investors. And you need to have the institutional investors, large institutional investor who has a staying power. You don't want to actually have the flippers. That's what they call. To have that staying power, and they actually invest in a certain packet size. They don't invest in 10 million, they invest in 100 millions or 200 or 500 millions, much larger packet size. To have that, you need to have a certain scale. That is the reason. And every company decides what that scale is. Because when you're not public, your future is very much in your own hands. Right? I mean, just to give an example, one of the benefit I had compared to probably Dominic is, now Dominic had huge access to public funds, I did not have, but the benefit which I had for that side is, for me, my shareholders and the board are synonymous. We had probably 8 and 9 member board, out of which 3 are shareholders. So if I have to get approval for a creative thing or to investment, I used to get approval in the same board meeting. I don't have to do analyst day and all the other stuff. I don't have to do, right? So as a CEO, and especially I was part of the public company before, as a CEO, I realized that if I want to build a company to a certain extent, then I want to have that independence and freedom with me for as much foreseeable future as possible. Now that is in conflict with your investors, because my investors, whether VCs or Ps, they have their fund life, right? So the only option I have is either to take it public earlier or actually keep on changing in investors every 3 to 5 years, and then you actually go higher and higher. And that's the path I took. It's not like that path everybody will take. That's the path I took. If you ask the same question, I'm sure with EPAM CEO, which is a great friend, and Globant CEO, they will say, no, I think they did brilliantly great. I think they took the company public and they actually grew the company. If you take their 15, 20, 25, I think 40, 50 quarters, I think they did a phenomenal job. But that's a decision. It's very important. The best relationship between investors and management, when they're making decisions together and the investors actually trust management to make the decision. And our decision was we need to get to a certain scale and size and certain metrics before actually seeing the public market.
Thanks, Shashank. Dominic, just an add-on question to that. You've been a public company CEO for a long time. How does the time you spend changes between internal customers and investors when you become a public company CEO? How do you think about your day and time spent?
Yeah, it's a great question. I was going to add on Shashank to answer Vitold. Vitold, the size of the company, it's also related to that, because as soon as you are public and regulated, you got dragged into complexity, depending the jurisdiction, which is all the compliance and so on and so forth, but it's also the reporting, the transparency level, which is, by the way, on one end good, but it's time consuming, and all the roadshow. So in my case, although I had a strong shareholder, thank God, who was a PE owning 29%, I shifted 30% of my time, which is huge, to the capital market in terms of roadshow. Why is that? Is because you report the numbers every quarter, but then any acquisition, back to what Shashank was doing, you need to go explain why. Even if it is in my delegation, the bigger one, you need to ask a general assembly and then go through a real roadshow and so on. And when something goes wrong, it was the case with my last acquisition, we found a forgery in the recent acquisition. So I had to spend, no kidding, to understand that in 4 months in 2018, I had to go around the planet doing 182 investor meetings physically. I almost died. So it is the duty of being listed, and you cannot grumble, because if you are listed and accessing public capital, then you need to honor that. So I had to go do that and so on. So you see why it is good when you have a certain size. But if you try to do that to a 300 million company, you're going to kill the management and the CEO for almost nothing.
Thank you very much.
Thanks, Dominic. Diego, thanks for being patient. If you can unmute and ask your question.
Yeah, sure. Thank you very much. Hey, I'll make a question that I'm pretty sure there is not a direct answer, but yet I'll ask for your experience on this. The question in my mind always is when should I do it? I mean, when should I mean, as you said, you never try to sell, but every day we receive offers, people are trying to come. The metrics or the KPIs are all, I mean, in our case at least, is there like the growth rate is over 100 every year. The customers are ready to grow with us. The team is ready to grow. So to the point that you have mentioned, Shashank, I think there is a benefit for either the team and the customers if we should do it. But again, the question in my mind is always when. I mean, what would be the right moment? Because we all understand Dominique described pretty well that consolidation is happening at an accelerated pace at this moment. And big customers are somehow linked to those consolidated groups or platforms that are growing. The question for me has been always, while I understand all of it, when should I do it is kind of a doubt that I never come to a solution in my mind.
Go ahead, Shashank. Dominic, go ahead.
I start fast and let Shashank elaborate. In fact, it's also a great question because there is no answer to that, right? Especially if you are the founder, it's a very personal choice and there are work-life balance aspect as well and so on. But the short answer for me would be, I guess, if you have the feeling that what you're going to do next alone is not going to be real great leverage. You see what I mean? There are windows where you know you're going to expand your company, and it's a pity to waste that because you cannot sell all the time the future, back to my expression. So it's better to materialize the future if you are confident. If one day you think that you can still do good, but with no real disruption, maybe it's the right moment to consider answering those calls. You see my point, right? It's a matter of leverage alone and not alone. And at some point of time, we all have a limit. By the way, one of the reasons why I accepted Capgemini was precisely that, without being too detailed. We knew that IT services and engineering was converging, and I knew that Altran would not be a giant in cloud, big data lakes. I could not do that. And I knew that if I was trying, I would lose my time. So I said, okay, let's sell.
Diego, this is my opinion. This is the question actually for the management team too. I think 2013, we came across this exact dilemma. I think our VCs said that we want to exit. And we had actually companies, which is like Accenture and Cognizant at that time. Frank was running the company. They were trying to actually bet on us. And I took my management team and asked them the question, you want to run long or you want to get out? We were a $240 million company then. And all my management team has said, you know what, Shashank, we spent last 3 years to build a platform which can actually take it up. It will be selling too cheap. In hindsight, actually, we would have sold it very cheap, right? But the thing is, I think that is one. But what we also realize is not 1 and 0. If you don't, you can always actually, if you can give the liquidity, if you can actually, we can do it in a smaller way. I think companies that are today, whether it's a PEs or whether financial investors are willing to come at probably around 20, 30, 40, 50% rate, and you can actually try that out. But the question you have to answer is, you and the management team have the enough gas, enough excitement, enough drive to take it forward. And the answer to that is yes. That means yes, you are actually going to do something much bigger. That's the question you have to answer. It's always difficult to answer that question. It's not easy, especially if we are external investors. It becomes even more difficult, or a public company. But I think what you're doing, that is a question you guys have to answer.
Great. So I think we are run out of time, but maybe we take the last question. Anand Raja, if you can unmute and you can ask the question.
Sure. Thanks, Shashank. Good to be seeing you again. And so of course, very insightful conversation. The question I had, Shashank, for you was, I know you said the curse of the services company is to be saying yes for everything. Is there any point in time that you think in the life of a company, we are about $100 million company now, that we should say yes to something? Maybe it's an existing customer that we have, they want us to do something that we don't do as core right now. Should we say yes at that point in time?
Yes, Anand, I think very good question. I think sometimes what happens is we are so deep in our business that we do not see a bigger picture of what's changing outside. And I'll give a classic example of this. In 2012, we were till around 2011, 2012, close to around, Pari knows this, our 80% business, 90% business was working in technology ISVs, small and big, right? It's your technology infrastructure software companies. We are not in enterprise side of the business, which is like automotive and industrial and all those side. I get a call from one of the top Verizon executive on my desk, and I think in 2012 beginning, and I was CEO. I just took it as CEO, and get a call and say that we heard about you from Google. We are trying to create the next generation OTT solution. Why don't you actually come and meet me in New Jersey? He's one of the very top executives, and you might have heard the name behind. I'll not actually say it over here. And in my naivety, I said that we do not work with CIOs. She was a CIO of Verizon. I said, no, we don't work with CIO. We only work with the engineering companies and engineering executives. She tried to explain me for probably around 3 or 4 minutes. And after that, she's a very smart executive, using expletives, she basically tried to get my ex actually in New Jersey within the next week. And I think she was so forceful that I said yes. And that is the beginning of we appreciating that enterprises will become the technology software companies. Verizon was our first client, which has shown us that they're trying to become themselves as a software company, and they have tremendous R&D today. If you really see what they do across the board, from telematics to going to OTTs to everything, right? And that is the time actually we realized after that meeting, it changed. So I think there is sometimes something coming from such a left field, and especially for your C-level executives, you should take the call. One of my biggest complaint about many of the CEOs, and I had about me, is we get so internally focused that we don't meet each other as a CEOs, like what Pari is trying to do over here. We don't meet enough analysts. We don't meet actually enough in the conferences. We don't invite our competition, right? When you do that, you get to know actually where the competition is coming from, left or right. If that call would not have been taken, that area we would not have said. And by the way, what we worked on was the Redbox incident that time, which is competition to Netflix. It would not have worked that time. Today, my 32% business actually coming from communications and media. That would not have happened. That would not have happened in terms of changing the company's trajectory. It would have still stayed actually working just with technology software companies and very, very, very small scale. So yes, to answer to your question is yes. And oftentimes clients tell you better, or the advisors like Pari tells better. But there are times, Pari, you and I sat together and we had debate on the table. And I may not agree with the view. And probably 9 months later, I said, I think he had a point actually over there. So I think it's as a CEOs, and don't hit me on this, but on the CEOs, we get used to actually start loving and believing our own image, right? Because you're actually top of the organization. But you also should be a learner, and that can happen by the advisors, by the clients, and sometimes try to explore a little different than what we do. And our fellow CEOs.
Great. I think we run out of time, and thanks a lot, Dominique and Shashank. It was super insightful. I learned quite a bit talking to you. I know both of you for a long time, but still I learned quite a bit, deep insights. Thanks for all the founders and dreamers with all your ambitions. We look forward to the next stage of your companies. And thanks again. And we will do this on a regular basis and ensure that you're able to learn and get all the CEOs together. Like Shashank, you mentioned, get everybody to learn together so that as the industry, we continue to up level overall. Thank you again. Thanks for your time. We will summarize some of the insights from this session and send it out to you. And we can continue to engage in some form or another to chat about some of the insights we had discussed today. Thank you, everyone.
Thank you, Pari.
Thanks.
Thanks.
Bye.
Thanks.
Thank you very much. Bye.
Thank you, Shashank. Bye.